Hello, and welcome to our guide on essential finance tips for students in the United States. This is designed to provide you with foundational knowledge to help you navigate your personal finances during your academic years and beyond. In this first chapter, we will lay the groundwork for your financial wellness journey. Before we begin, it is crucial to understand that the information provided in this series is for educational purposes only. I am not a licensed financial advisor, and the content presented here should not be considered as financial, investment, tax, or legal advice. The financial landscape in the United States is governed by a complex set of laws and regulations. Therefore, it is highly recommended that you consult with a qualified professional for advice tailored to your individual circumstances. Our goal is to empower you with knowledge so you can make informed decisions about your financial future. Always do your own research and due diligence. Now, let's dive into the foundations of financial wellness. As a student, you are at a unique and pivotal point in your life. The habits you form now can have a lasting impact on your financial well-being. Think of this time as a training ground for your financial future. The lessons you learn and the practices you adopt will serve you for decades to come. So, what is financial wellness? In simple terms, it's a state of being where you have a sense of security and control over your finances. It means you can meet your current and ongoing financial obligations. You feel confident in your financial future, and you are able to make choices that allow you to enjoy life. It's not about being wealthy, it's about being in control. The first step towards financial wellness is understanding your mindset about money. For many, money is a source of stress and anxiety. It's a topic often shrouded in mystery or considered taboo to discuss. However, developing a positive and proactive money mindset is fundamental. See money not as an end in itself, but as a tool to help you achieve your goals. Whether that's graduating with minimal debt, traveling, or starting a business after college. A key component of a healthy financial mindset is taking ownership of your financial situation. It's easy to feel overwhelmed, especially with the costs of tuition, housing, and daily life. But remember, you are in the driver's seat. You have the power to make conscious decisions about your spending and saving habits. This sense of agency is incredibly empowering and is the first significant step towards building a solid financial foundation. Let's talk about the importance of setting financial goals. Without goals, your financial efforts can lack direction. Think about what you want to achieve financially, both in the short term and the long term. A short-term goal might be to save enough money for a new laptop or to avoid credit card debt this semester. A long-term goal could be to graduate with a certain amount of savings or to start building a positive credit history. When setting your goals, make them SMART, specific, measurable, achievable, relevant, and time-bound. For example, instead of saying, "I want to save more money," a SMART goal would be, "I will save $300 for my spring break trip by putting aside $25 from my part-time job every week for the next 12 weeks." This clarity will help you stay focused and motivated. Another foundational concept we need to discuss is the difference between needs and wants. This might seem basic, but in a world of constant advertising and social media pressures, the line can easily become blurred. Needs are the essentials for survival and well-being. Housing, food, transportation to class and work, and necessary school supplies. Wants are everything else. The daily coffee from a cafe, the latest smartphone, or a new outfit for a party. Understanding this distinction is not about depriving yourself of everything you want. It's about making conscious spending decisions. By prioritizing your needs, you can then make informed choices about how to allocate the remaining funds to your wants, in a way that aligns with your financial goals. We will delve deeper into creating a budget in a later chapter, but for now, start to critically evaluate your purchases. Before you buy something, ask yourself, is this a need or a want? This simple question can be a powerful tool in curbing impulsive spending. Finally, let's touch upon the importance of financial literacy. Financial literacy is the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. By listening to this audio series, you are already taking a positive step towards improving your financial literacy. Continue to seek out knowledge from reputable sources. Your university may offer free financial literacy workshops or counseling services. There are also numerous nonprofit organizations and government websites dedicated to providing unbiased financial education. In summary, this first chapter has introduced the core concepts of financial wellness for students in the U.S. We've emphasized the importance of a positive money mindset, taking ownership of your finances, setting clear and achievable goals, distinguishing between needs and wants, and the ongoing journey of improving your financial literacy. Remember, building a strong financial foundation is a marathon, not a sprint. Be patient with yourself, celebrate small victories, and don't be afraid to seek help when you need it. By embracing these foundational principles, you are setting yourself up for a more secure and empowered financial future. Thank you for joining me in this first chapter. In our next session, we will explore the critical skill of creating a realistic budget that works for a student's lifestyle. Welcome back to our series on essential finance tips for students in the United States. In our first chapter, we laid the groundwork by discussing the mindset and foundational principles of financial wellness. Today, in Chapter 2, we're going to build upon that foundation by tackling one of the most powerful tools in personal finance, budgeting. Before we dive in, let's reiterate our important disclaimer. The information in this audio series is intended for educational purposes only and should not be construed as financial, investment, tax, or legal advice. I am not a licensed financial professional. All financial decisions should be made in consultation with qualified professionals who can provide advice tailored to your specific situation. Our aim here is to educate and empower you with knowledge. The word budget can sometimes sound restrictive or intimidating, but I encourage you to think of it differently. A budget is not about limiting your fun, it's about creating a plan for your money. It's a roadmap that shows you where your money is coming from and where it's going, empowering you to direct it towards what matters most to you. For a student, a budget is your single best tool for managing cash flow, reducing financial stress, and achieving your goals, whether that's avoiding debt or saving for a post-graduation trip. The first step in creating any effective budget is to understand your income. As a student, your income might come from various sources. This could include part-time jobs, work-study programs, scholarships, grants, money from your family, or student loan disbursements. Take some time to list all your sources of income for a typical month. If your income is irregular, for example, you work more hours some weeks than others, try to calculate a conservative monthly average. It's always better to underestimate your income and have a surplus than to overestimate it and fall short. Once you have a clear picture of what's coming in, the next step is to track what's going out. This is often the most eye-opening part of the budgeting process. For 1 month, track every single dollar you spend. You can do this with a simple notebook, a spreadsheet on your computer, or by using one of the many free budgeting apps available for your smartphone. Be honest and thorough. Record everything from your rent and tuition payments to that morning coffee or late-night pizza. After you've tracked your spending for a month, the next step is to categorize your expenses. This will help you see exactly where your money is going. Common categories for students include: first, housing. This would be your rent or dorm fees. Second, utilities, such as electricity, water, and internet. Third, tuition and fees, costs directly related to your education. Fourth, textbooks and supplies, necessary materials for your classes. Fifth, groceries, food you buy to cook and eat at home. Sixth, transportation. This could be gas for your car, public transit passes, or ride-sharing services. Seventh, personal care, things like toiletries and haircuts. And finally, a category for discretionary spending. This includes dining out, entertainment, shopping for non-essentials, and subscriptions. Now, with your income understood and your expenses tracked and categorized, you can see the full picture. You can clearly identify areas where you might be overspending and where you have opportunities to save. This brings us to choosing a budgeting method. There isn't a one-size-fits-all approach. The best budget is the one you can stick with. A popular and simple method is the 50/30/20 rule. This framework suggests allocating 50% of your after-tax income to needs, 30% to wants, and 20% to savings and debt repayment. Let's break that down. Your needs are those essential expenses we discussed in Chapter 1. Rent, utilities, groceries, and transportation. These are the costs you must cover each month. 50% is a guideline. For students in high cost of living areas, this percentage might be higher, which means adjustments will be needed elsewhere. Next, wants are the discretionary items that make life more enjoyable but aren't essential. Eating out, concert tickets, streaming services, and new clothes. Allocating about 30% of your income here allows you to enjoy your student life without derailing your finances. Finally, and critically, 20% of your income should be directed towards savings and paying down any existing debt, like a credit card balance. It's crucial to pay yourself first by treating your savings contribution as a non-negotiable bill. Automating this can be very effective. Set up an automatic transfer from your checking account to a savings account each month, right after you receive your income. This ensures you're consistently building your savings without having to think about it. Another budgeting method is the zero-based budget. With this approach, you assign every single dollar of your income to a specific category: expenses, savings, or debt payments. Your income minus your expenses should equal zero. This method is incredibly detailed and forces you to be intentional with every dollar you earn. Regardless of the method you choose, remember that a budget is a living document. It should be flexible. Life is unpredictable. You might have an unexpected expense one month, or your income might change. The key is to review your budget regularly, perhaps once a week or every 2 weeks, to make sure it still reflects your financial reality and is helping you move toward your goals. Don't be discouraged if you overspend in one category. Just adjust and try to get back on track. The goal is progress, not perfection. To wrap up this chapter, creating a budget is about giving you control and freedom. It's a proactive step that reduces uncertainty and empowers you to build a secure financial future. Start by tracking your income and expenses, categorize them to see the full picture, choose a budgeting method that suits you, and be consistent in reviewing and adjusting your plan. Thank you for listening. In our next chapter, we will discuss the important topic of banking and how to choose the right checking and savings accounts for your needs as a student. Hello and welcome back. In our last chapter, we detailed how to create a financial roadmap with a personal budget. Today, in Chapter 3, we'll discuss the vehicle for that roadmap: your bank accounts. Selecting the right place to manage your money is a critical step in your financial journey, providing you with the tools to handle your day-to-day expenses and plan for the future. As we begin, please remember our standard disclaimer. This audio series is for educational purposes only. The information provided is not intended as financial, legal, tax, or investment advice. I am not a licensed financial advisor. You should always consult with a qualified professional to get advice that is tailored to your unique personal circumstances. Our mission is to provide you with general knowledge to help you make more informed decisions. For many students, this might be the first time you're opening a bank account on your own. The process can seem daunting with so many options available, from large national banks to local community banks and credit unions. However, by focusing on a few key features, you can find accounts that are a great fit for your student lifestyle. Let's start with the two primary types of accounts you'll need: a checking account and a savings account. Think of a checking account as your financial hub for daily transactions. This is where your income, whether from a job, parents, or student loans, will likely be deposited. You'll use this account for everyday spending through a debit card, writing checks, or making online payments. The key purpose of a checking account is easy access to your money. A savings account, on the other hand, is designed for your short-term to medium-term goals. This is where you'll put money that you don't need for immediate expenses. The primary benefit of a savings account is that it typically earns interest, which means the financial institution pays you a small percentage of your balance for keeping your money with them. While the interest rates may be modest, it's a great way to let your money grow over time. Access to funds in a savings account is slightly more limited than a checking account, which can be a good thing, as it discourages you from dipping into your savings for non-essential purchases. When you begin looking for a place to open these accounts, there are several crucial factors to consider, especially as a student. The number one priority should be to find accounts with low or, ideally, no monthly maintenance fees. Many banks offer specific student accounts that waive these fees for individuals enrolled in school, typically until the age of 24 or 25. A monthly fee of $5 or $10 might not sound like much, but it can add up significantly over a year. Another key feature is the minimum balance requirement. Some accounts require you to keep a certain amount of money in the account at all times to avoid fees. As a student with a fluctuating income, it's best to look for accounts that have no minimum balance requirement. Next, consider accessibility. How easily can you access your money when you need it? Look at the bank's ATM network. Does it have ATMs on or near your campus? Using an out-of-network ATM can result in fees from both your bank and the ATM owner. Also, in today's digital world, robust online and mobile banking services are essential. A good mobile app will allow you to check your balances, deposit checks by taking a picture, transfer money, and pay bills right from your phone. Now let's talk about one of the biggest pitfalls in banking: fees. Beyond the monthly maintenance fee, there are others to be aware of. Overdraft fees are a significant one. This fee is charged when you spend more money than you have in your checking account. These fees can be quite high. Some banks offer overdraft protection, which links your checking account to your savings account or a line of credit to cover the shortfall. Though this service might also have a fee, An even better option for students is to simply decline overdraft services. This means if you don't have enough funds, your transaction will be declined, which is much better than paying a hefty fee. When comparing institutions, consider the differences between a traditional bank and a credit union. Banks are for-profit institutions, while credit unions are non-profit cooperatives owned by their members. Because of this, credit unions often offer lower fees, better interest rates on savings, and more personalized customer service. Membership in a credit union is typically based on a common bond, such as attending a particular university, living in a specific community, or being part of a certain group. It's worth checking if your university has an affiliated credit union. In summary, choosing the right bank accounts is a foundational step. You will likely need both a checking account for daily spending and a savings account to build for your future. When comparing your options, prioritize accounts with no monthly fees and no minimum balance requirements. Ensure the bank or credit union has convenient ATM access and a high-quality mobile banking app. Finally, be vigilant about avoiding fees, especially overdraft fees, by carefully managing your account balance. Thank you for your time today. In our next chapter, we will delve into the world of credit, what it is, why it's important, and how you can begin to build a positive credit history as a student. Welcome back to our series on essential finance tips for students in the United States. In our previous chapter, we covered the basics of choosing the right bank accounts. Today, in Chapter 4, we are going to demystify a topic that is fundamental to your financial life in the U.S. Credit. Understanding what credit is, how it works, and how to build it responsibly is one of the most important financial lessons you can learn as a young adult. Before we proceed, we must restate our important disclaimer. The content provided in this series is for educational purposes only and should not be considered as personalized financial, legal, tax, or investment advice. I am not a licensed financial advisor. It is highly recommended that you consult with a qualified professional for guidance specific to your individual circumstances. Our goal is to provide you with the knowledge to navigate your finances with confidence. So, what exactly is credit? In the simplest terms, credit is your ability to borrow money with the promise to pay it back later. When a lender extends you credit, they are trusting you to repay the amount you borrowed, usually with interest, which is the cost of borrowing the money. Your history of borrowing and repaying money creates your credit history, which is essentially your financial reputation. This reputation is incredibly important in the United States. Lenders, landlords, insurance companies, and even some potential employers may look at your credit history to assess your reliability. A positive credit history can open doors to more favorable interest rates on future loans for a car or a home, make it easier to rent an apartment, and can sometimes even lead to lower insurance premiums. Conversely, a negative credit history, or no credit history at all, can make these things more difficult and more expensive. Your credit history is documented in a credit report, which is a detailed record of your borrowing activities. 3 major credit bureaus in the U.S., Equifax, Experian, and TransUnion, collect this information. Your credit report includes details about your credit accounts, such as credit cards and loans, your payment history, and how much debt you carry. From the information in your credit report, a credit score is calculated. A credit score is a 3-digit number that serves as a snapshot of your creditworthiness at a particular point in time. The most common scoring models are FICO and VantageScore, and they typically range from 300 to 850. A higher score indicates to lenders that you are a lower-risk borrower, while a lower score suggests a higher risk. Several key factors influence your credit score. The single most important factor is your payment history. Consistently making your payments on time is the best thing you can do to build a positive credit history. Late payments can have a significant negative impact on your score. The second most important factor is your credit utilization ratio. This refers to the amount of credit you are using compared to your total available credit. For example, if you have a credit card with a $1,000 limit and you have a balance of $300 on it, your credit utilization is 30%. It is generally recommended to keep your overall credit utilization below 30%. High utilization can signal to lenders that you may be overextended. Other factors include the length of your credit history. A longer history is generally better. The mix of credit you have, such as credit cards and installment loans, and how often you apply for new credit. Now, as a student, you might be thinking, how can I build a credit history if I've never borrowed money before? This is a common challenge, but there are safe ways to get started. One common path is by becoming an authorized user on a parent's or guardian's credit card. This means you can use the card, but the primary account holder is ultimately responsible for the bill. If the primary user has a long history of on-time payments, that positive history can be reflected on your credit report and help you build your own credit profile. Another option may be a secured credit card. With a secured card, you provide a cash deposit to the bank, and that deposit typically becomes your credit limit. For example, you might deposit $200, and your credit limit will be $200. This minimizes the risk for the lender. By using the card for small purchases and paying the bill in full and on time each month, you can demonstrate responsible credit behavior. After a period of consistent payments, many lenders will upgrade you to an unsecured card and refund your deposit. Some students may also qualify for a student credit card. These are unsecured cards designed for college students who have limited or no credit history. They often have lower credit limits and may have higher interest rates, so it is crucial to use them responsibly. The golden rule of using a credit card is to only charge what you can afford to pay off in full each month. Carrying a balance from month to month means you will be charged interest, which can become very expensive very quickly. To wrap up this chapter, your credit is your financial reputation. Building a positive credit history takes time and consistency. It starts with understanding the factors that make up your credit score, primarily paying your bills on time, and not using too much of your available credit. For students, safe starting points can include becoming an authorized user or using a secured credit card responsibly. Thank you for joining me. In our next chapter, we will take a deeper dive into the world of credit cards, discussing how to use them wisely and avoid common pitfalls. Hello and welcome back. In our last chapter, we introduced the concept of credit and its importance to your financial life in the United States. Today, in Chapter 5, we will focus specifically on one of the most common tools for building and using credit, the credit card. Used wisely, a credit card can be a convenient and safe way to make purchases and build a positive credit history. However, if misused, it can lead to significant debt. Our goal today is to equip you with the knowledge to use credit cards responsibly. As always, we must begin with our important disclaimer. This audio series is for educational purposes only. The information presented here should not be interpreted as financial, investment, legal, or tax advice. I am not a licensed financial professional. For advice tailored to your personal situation, it is essential that you consult with a qualified and licensed advisor. Our purpose is to provide general financial education to empower your decision-making. In the previous chapter, we touched on how student or secured credit cards can be a starting point for building credit. Once you have a card, the most critical lesson is this: a credit card is not free money. It is a loan. Every time you swipe, tap, or enter your card information online, you are borrowing money from the card issuer. The fundamental rule for responsible credit card use is to only charge what you can afford to pay back in full by the end of the month. To understand why this is so important, we need to talk about a key term: the annual percentage rate, or APR. The APR is the interest rate for a whole year, applied to your credit card balance. If you don't pay your full balance by the due date, the card issuer will charge you interest on the remaining amount. Credit card APRs can be quite high, which means that carrying a balance from one month to the next can become very expensive, very quickly. Let's look at an example. Imagine you have a $500 balance on a card with a 20% APR. If you only make small payments, a significant portion of that payment will go just to cover the interest charge, with very little going toward the actual $500 you owe. This is how people can get trapped in a cycle of debt, where it feels like they are making payments but the balance hardly decreases. To avoid this, you need to understand your credit card statement. A few key items to look for are the statement balance, the minimum payment, and the payment due date. The statement balance is the total amount you owe at the end of that billing cycle. The payment due date is the deadline by which you need to make your payment to be considered on time. Then there's the minimum payment. This is the smallest amount of money the credit card company requires you to pay by the due date to keep your account in good standing. It is very tempting to only pay this small amount, but doing so is a major financial trap. Paying only the minimum means the rest of your balance will be subject to that high APR, and it could take you years, and a lot of extra money and interest, to pay off your original purchase. The best habit you can form is to always pay the full statement balance on, or before the due date. Fortunately, most credit cards offer a grace period. A grace period is the time between the end of a billing cycle and your payment due date. If you pay your entire balance in full before the grace period ends, you will not be charged any interest on your new purchases. However, if you carry a balance from a previous month, you typically lose the grace period, and new purchases may start accruing interest immediately. Paying in full every month preserves this interest-free benefit. So, what are some practical tips for using your first credit card wisely? First, treat it like a debit card. This means only making purchases that you know you have the cash to cover in your checking account. Get into the habit of checking your credit card activity online every few days to keep track of your spending. Second, start small. Use your card for 1 or 2 small, predictable purchases each month, like a streaming subscription or your cell phone bill. This helps you establish a history of on-time payments without the risk of overspending. Third, set up payment reminders and, if possible, automatic payments. You can set up an automatic payment to cover at least the minimum amount, which acts as a safety net to ensure you're never late. However, it is still best to manually pay the full balance each month. Finally, read the terms and conditions of your card. Understand its APR, and be aware of any potential fees such as annual fees, late payment fees, or foreign transaction fees. Being an informed user is your best defense against unexpected costs. In summary, a credit card is a powerful financial tool when used with discipline. The keys to success are to never charge more than you can pay off, to always pay your statement balance in full by the due date, and to understand the terms of your account. By following these principles, you can avoid debt and build a positive credit history that will benefit you for years to come. Thank you for listening. In our next chapter, we will explore the complex but crucial topic of student loans. Hello, and welcome back to our financial education series. In our last chapter, we navigated the responsible use of credit cards. Today, in Chapter 6, we address one of the most significant financial topics for students in the United States: student loans. For many, student loans are an essential tool for funding a higher education. Understanding how they work is the first step toward borrowing responsibly and managing your debt effectively after graduation. As we delve into this complex topic, we must begin with our critical disclaimer. The information provided here is for educational and informational purposes only and does not constitute financial, legal, or tax advice. I am not a licensed financial advisor. Student loans are a binding legal agreement, and the rules surrounding them can be complex. It is imperative that you do your own thorough research and consult with financial aid professionals or qualified financial advisors to understand the best path for your individual circumstances. First, let's establish what a student loan is. It is a form of financial aid that must be repaid with interest. Unlike grants or scholarships, this is borrowed money. When you take out a student loan, you are making a commitment to pay that money back. This is a significant responsibility that can affect your finances for many years after you leave school. In the United States, there are 2 main categories of student loans: federal and private. It's crucial to understand the difference. Federal student loans are funded by the U.S. Department of Education. They come with several key benefits and protections that are established by federal law. These can include fixed interest rates, which means the rate won't change over the life of the loan, and various repayment plans, including income-driven repayment options that can adjust your monthly payment based on how much you earn. Federal loans also offer options for deferment and forbearance, which allow you to temporarily postpone payments under certain circumstances, as well as potential eligibility for loan forgiveness programs, particularly for those in public service careers. Within federal loans, you'll often hear the terms subsidized and unsubsidized. A direct subsidized loan is available to undergraduate students with demonstrated financial need. The key benefit here is that the U.S. Department of Education pays the interest on the loan while you're in school at least half-time, for the first 6 months after you leave school, known as the grace period, and during periods of deferment. With a direct unsubsidized loan, you are responsible for paying the interest during all periods. If you choose not to pay the interest while you are in school, it will accumulate and be added to the principal amount of your loan, a process known as capitalization. Private student loans, on the other hand, are made by private organizations such as banks, credit unions, and state-based organizations. The terms and conditions for private loans are set by the individual lender, not the federal government. This means they can have variable interest rates, which can rise or fall over time, and they typically offer fewer flexible repayment options and protections compared to federal loans. Often, a private loan will require a credit check and may require a cosigner if the student has a limited credit history. Because of the benefits and protections they offer, financial aid experts often suggest that students should exhaust their federal loan options before considering private loans. Regardless of the type of loan, it's vital to be a responsible borrower from the very beginning. The most important rule of borrowing is this: only accept the loan amount you absolutely need. When you are approved for a certain loan amount, you do not have to accept the full sum.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Your school's financial aid office will provide a cost of attendance, which is an estimate of tuition, fees, housing, food, and other necessary expenses. Use this as a guide to determine how much you need to borrow, but if you can reduce costs, for instance by living more frugally, you should borrow less. The less you borrow now, the less you have to repay later. Keep meticulous records of all the loans you take out. Know who your loan servicer is. That's the company that will handle your billing, and understand the terms of each loan, including the interest rate, and when you'll have to start making payments. Most federal student loans have a 6-month grace period after you graduate, leave school, or drop below half-time enrollment. This is the period before you must begin making payments. Use this time to get organized and prepare your budget for loan repayment. In summary, student loans are a serious but manageable financial tool. Understanding the fundamental differences between federal and private loans is your first step. Federal loans generally offer more protections and flexible repayment options. A core principle of responsible borrowing is to only take what you truly need to cover your essential educational expenses. Keep organized records and be proactive in understanding the terms of your commitment. Thank you for your attention. In our next chapter, we will shift our focus to the other side of the financial equation: earning money and managing income as a student. Hello and welcome back. So far in our series, we have covered budgeting, banking, credit, and borrowing. In Chapter 7, we are shifting our focus to the other side of the ledger: earning and managing income. For many students, college is the first time you'll be juggling academics with a job. Learning how to manage the money you earn is a vital skill that complements everything we've discussed and sets you up for future success. Before we explore this topic, let's begin with our essential disclaimer. The information in this audio chapter is for educational and general informational purposes only. It is not intended to be, and should not be taken as financial, tax, or legal advice. I am not a licensed financial advisor, tax professional, or attorney. You should consult with qualified professionals for advice pertaining to your specific financial and legal situation, especially regarding employment and taxes. Earning an income as a student provides more than just spending money. It can help offset educational costs, reduce your reliance on student loans, and provide valuable work experience. There are several common avenues for student employment in the U.S. One of the most common is a part-time job. These can be on or off campus and may or may not be related to your field of study. They offer flexibility to fit around your class schedule and provide a steady stream of income. Another source is paid internships. Internships are excellent because they not only provide income but also give you hands-on experience in your chosen career, which can be invaluable after graduation. You may also encounter federal work-study programs. Work-study is a form of financial aid that you must be approved for when you fill out your free application for Federal Student Aid, or FAFSA. If you qualify, the program funds part-time jobs for students with financial need. These jobs are often on campus, and the employers are accustomed to working with student schedules, making them a convenient and flexible option. Once you secure a job, you will receive your first paycheck, which can be an exciting moment. However, it's important to understand the details of what you're actually earning. You will notice two key figures: gross pay and net pay. Your gross pay is the total amount of money you earn before any deductions are taken out. For example, if you work 20 hours a week at $15 an hour, your gross pay for that week is $300. However, the amount that gets deposited into your bank account, your net pay, or take-home pay, will be less than that. This is because your employer is required by law to withhold money for taxes. These deductions can include federal income tax, state income tax, in most states, and FICA taxes. FICA stands for the Federal Insurance Contributions Act, and it's a U.S. federal payroll tax that funds Social Security and Medicare. Understanding these deductions is crucial for budgeting. When you calculated your income in Chapter 2, it's your net pay, not your gross pay, that you should be using for your budget, as this is the actual amount you have available to spend and save. When you start a new job, you will be asked to fill out several forms, including the Form W-4 from the IRS. The purpose of the W-4 is to help your employer determine how much federal income tax to withhold from your paycheck. The form will ask you for information about your filing status and any other income you might have. It's important to fill this out accurately. While we cannot provide tax advice, the general principle is that filling out the form correctly helps you avoid having too little tax withheld, which could result in a tax bill at the end of the year, or having too much withheld, which means you are essentially giving the government an interest-free loan. Once you have your paycheck, the principles of managing it are straightforward. The very first step should be to pay yourself first, a concept we introduced earlier. Before you pay any bills or spend any money, direct a portion of your income into your savings account. Automating this transfer is the most effective way to ensure it happens consistently. Next, use your income to cover the expenses you've laid out in your budget. Having a regular income stream makes it easier to manage recurring bills and daily spending. It also gives you the power to make conscious decisions. With your own earnings, you can decide how to balance your needs, wants, and savings goals. This practice is fundamental to building lifelong financial discipline. In summary, earning an income as a student is a major step toward financial independence. Explore various job opportunities like part-time work, internships, or work-study programs. When you get paid, understand the difference between your gross and net pay, and base your budget on the actual amount you take home. Be diligent when filling out employment forms like the W-4. Finally, manage your earnings wisely by prioritizing savings and sticking to your budget. Thank you for listening. In our next chapter, we will delve into the critical topic of protecting yourself from identity theft and financial scams. Hello and welcome back to our series. In our journey so far, we've talked about building positive financial habits. In Chapter 8, we're going to discuss how to protect what you're building. In today's digital world, safeguarding your personal and financial information is more important than ever. Students can be specific targets for scams and identity theft, so awareness is your strongest defense. As we navigate this crucial topic, we must begin with our standard disclaimer. The information in this chapter is for educational and general informational purposes only. It does not constitute legal, financial, or cybersecurity advice. I am not a licensed professional in these fields. For specific advice on protecting your identity, or what to do if you are a victim of a crime, you should consult with law enforcement and qualified legal or security professionals. Identity theft occurs when someone unlawfully obtains and uses your personal identifying information, such as your name, social security number, or credit card number, to commit fraud. For a student, this could mean someone opening a credit card in your name, or even taking out a loan. The consequences can be damaging to your credit and financial well-being. One of the most common ways that criminals try to steal your information is through phishing. Phishing scams often come in the form of emails, text messages, or social media messages that look like they are from a legitimate source, such as your bank, a government agency like the IRS, or even your university. These messages are designed to create a sense of urgency or panic. They might claim your account has been compromised, you owe money, or you've won a prize. Their goal is to trick you into clicking a malicious link or providing your personal information. Here is how to spot and avoid phishing attempts. First, be skeptical of unsolicited messages that ask for personal information or demand immediate action. Legitimate organizations will rarely, if ever, ask you to provide sensitive data like your password or social security number via email. Second, examine the sender's email address. Scammers often use addresses that are just slightly different from a real company's. Hover your mouse over any links, without clicking, to see the actual web address they lead to. If it looks suspicious, do not click it. If you are concerned the message might be real, contact the organization directly using a phone number or website you know to be authentic, not the information provided in the suspicious message. Beyond phishing, you must practice good digital hygiene. This starts with creating strong, unique passwords for all of your online accounts. A strong password is long and includes a mix of uppercase and lowercase letters, numbers, and symbols. Avoid using easily guessable information like your birthday or pet's name. Using a different password for each account is critical. That way, if one account is compromised, the rest of your accounts remain secure. Using a reputable password manager can help you create and keep track of complex passwords. Whenever it's offered, enable two-factor or multi-factor authentication. This adds a crucial second layer of security. Even if a scammer steals your password, they won't be able to access your account without the second verification step, which is usually a code sent to your phone. Be cautious about what you share on social media. Seemingly innocent details like your full date of birth, your high school, or your mother's maiden name are often the answers to security questions for financial accounts. Adjust your privacy settings to limit who can see your personal information. Physical security is just as important. Shred any documents that contain sensitive information before you throw them away. This includes credit card offers, bank statements, and receipts. Be mindful of your surroundings when entering your PIN at an ATM or a store. And never carry your Social Security card with you. Keep it in a secure location at home. Students are also common targets for specific types of scams. Be wary of too good to be true job offers that you didn't apply for, especially those that ask you to pay for training or equipment up front, or involve you receiving a large check and being asked to wire a portion of it back. These are almost always scams. Similarly, be cautious of fake scholarship or grant opportunities that require you to pay a processing fee. Legitimate financial aid sources do not operate this way. In summary, protecting your financial identity is an active, ongoing process. Be vigilant against phishing. Use strong and unique passwords. Enable two-factor authentication. And be mindful of what you share online and offline. By treating your personal information with the same care as you treat your money, you can significantly reduce your risk of becoming a victim of fraud. Thank you for listening. In our next chapter, we will discuss the importance of saving and investing for your future, even as a student. Hello and welcome back. In the past several chapters, we've focused on the core mechanics of managing your day-to-day finances. Now in Chapter 9, we are going to look toward the future by introducing the concepts of saving and investing. Understanding the difference between these two activities and the power of starting early can fundamentally change your financial trajectory. Before we discuss these topics, it is absolutely critical to state our most important disclaimer of this series. The information provided in this chapter is strictly for educational and informational purposes. It is not and should never be considered investment, financial, legal, or tax advice. I am not a licensed investment advisor or financial professional. All investment activities involve risk, including the potential loss of the principal amount invested. You must conduct your own thorough research and consult with a licensed and qualified financial professional before making any investment decisions. This content is designed to explain concepts, not to provide recommendations. Let's begin by clearly defining the difference between saving and investing. Saving is the act of setting aside money in a safe and easily accessible place for short-term goals or emergencies. When you save, your primary goal is capital preservation, meaning keeping your money safe. The money you put in a federally insured savings account is protected up to the coverage limit. This is the money you'll use for goals within the next 1 to 5 years. The most important savings goal for anyone, including a student, is to build an emergency fund. We've mentioned this before, but it's worth a deeper dive. An emergency fund is a cash reserve set aside specifically for unexpected expenses. This could be a sudden car repair, an unexpected medical bill, or the cost of a flight home for a family emergency. Having this fund in place prevents you from having to go into debt or sell an investment at the wrong time to cover a crisis. Even starting with a small goal, like saving $500, can provide a significant financial cushion and peace of mind. Investing, on the other hand, is the act of using your money to purchase an asset with the hope that it will generate a return or grow in value over time. Unlike saving, investing involves taking on risk for the potential of higher growth. The primary purpose of investing is to build wealth for long-term goals. Think of objectives that are more than 5 years away, such as retirement. As a student, you might think you don't have enough money to invest, or that it's too complicated. However, the single most valuable asset you have on your side right now is time. This is because of a powerful concept called compound interest, which some have called the eighth wonder of the world. Compound interest, or compound growth, is the process of earning a return not only on your original money, the principal, but also on the accumulated returns from previous periods. Let's imagine a simple, hypothetical example purely for illustration. If you have $100 and it earns a 10% return in a year, you now have $110. The next year, you earn a 10% return on the full $110, not just the original $100. So you earn $11. The following year, you earn a return on $121 and so on. Like a snowball rolling downhill, the effect is small at first, but over decades, it can lead to exponential growth. The earlier you start, the more time your money has to work for you. This is why even small, consistent contributions made in your late teens or early 20s can have a more significant impact than much larger contributions made later in life. So, how does one even begin to think about investing? The first step is education. It is essential to understand that there is a direct relationship between risk and potential return. Assets with the potential for higher returns typically come with higher risk. There is no such thing as a get-rich-quick scheme in legitimate investing. It is a long-term, disciplined process. There are many different types of assets one can invest in, such as stocks, which represent ownership in a company, and bonds, which are essentially a loan to a company or government. For beginners, a concept often discussed is diversification. This is the principle of not putting all your eggs in one basket. Spreading your money across different types of investments can help manage risk. Again, this information is not a recommendation to buy or sell anything. The purpose is to introduce you to the vocabulary and core principles, so you can begin your own educational journey. Reputable sources for learning include government websites like investor.gov, which is run by the U.S. Securities and Exchange Commission, or FINRA.org. In summary, saving and investing are two distinct but equally important parts of a healthy financial plan. Saving is for short-term needs and safety, with an emergency fund being your top priority. Investing is a long-term strategy for wealth growth that involves risk. As a student, your greatest advantage is time, which allows you to harness the incredible power of compounding. Thank you for listening. In our next chapter, we will explore the concept of financial planning for major life events that you may encounter after graduation. Hello and welcome back to our series. In the last chapter, we introduced the forward-looking concepts of saving and investing. Today, in Chapter 10, we'll bring that forward-looking perspective a little closer to home and discuss how to begin financially planning for the major transition out of college and into your next chapter, whatever that may be. Graduation is an exciting milestone, and a little financial preparation can make the journey into post-student life much smoother. As always, we must begin with our essential disclaimer. The information provided in this chapter is for general informational and educational purposes only. It is not intended to provide, and should not be relied on for, financial, legal, tax, or career advice. I am not a licensed professional in these fields. You should consult with the appropriate qualified professionals for advice regarding your specific circumstances. As you approach your final year of college, your financial picture is likely to change significantly. You might be starting a full-time job, moving to a new city, or continuing your education. Each of these paths comes with its own set of financial challenges and opportunities. The key is to be proactive, not reactive. The first step is to create a transition budget. This is different from the student budget we discussed in Chapter 2. A transition budget is a forward-looking estimate of what your income and expenses will look like in the first 6 months after you graduate. Start by estimating your post-graduation income. If you have a job offer, this will be relatively straightforward. Look at the salary offered, but remember to estimate your net pay, your take-home pay, after taxes and other deductions. A conservative estimate is that your net pay will be around 25 to 30% less than your gross salary, though this varies greatly by state and individual circumstances. If you don't have a job lined up yet, create a budget based on a realistic, entry-level salary for your field of study and desired location. This exercise can also help you understand the minimum salary you'll need to live comfortably. Next, and just as important, is to estimate your new expenses. Some of your student-era expenses will disappear, like tuition payments or on-campus housing fees. However, a new set of adult expenses will take their place. These can include student loan payments, which will typically begin about 6 months after you graduate. Health insurance premiums, if you are no longer covered under a parent's plan. Professional work attire. Transportation costs, which may change significantly if you have a new commute. And potentially, retirement contributions, which we will discuss in a future chapter. One of the largest new expenses for many graduates is the cost of moving and setting up a new household. If you're relocating for a job, you'll need to budget for the costs of the move itself, a security deposit for an apartment, which is often equivalent to 1 month's rent, and potentially the first and last month's rent. You might also have costs for setting up utilities and buying furniture and other household necessities. These one-time costs can be substantial, so it's a great idea to start saving for them well before you graduate. As you plan, it's also a good time to revisit your financial goals. Your short-term goals may now include building up your emergency fund to cover 3 to 6 months worth of your new, higher living expenses. Your long-term goals might start to include saving for a down payment on a car, or even a future home. While you're still a student, you can take several practical steps. First, focus on saving as much as you can. Any extra cash you can put aside during your senior year will be incredibly valuable in covering those post-graduation transition costs. Second, begin to organize your financial life. Make a master document with all of your account information, bank accounts, credit cards, and especially your student loans. Know your loan servicer's contact information, and create an online account so you are ready when the first payment comes due. Third, continue your financial education. The learning process doesn't stop with this audio series. The financial world is always changing. Make it a habit to read reputable financial news sources and blogs. Understanding the basics of topics like employee benefits, retirement accounts, and insurance will be immensely helpful as you start your career. In summary, planning for life after graduation is about anticipating and preparing for a new financial reality. Create a transition budget to estimate your future income and expenses. Start saving specifically for the costs of moving and setting up your new life. Get your financial documents organized, and commit to being a lifelong learner when it comes to managing your money. A little bit of planning now can prevent a lot of stress later. Thank you for listening. In our next chapter, we will discuss the basics of insurance and why it's a crucial part of your financial safety net. Hello and welcome back to our series. In our last chapter, we discussed planning for the major life transition after graduation. Today, in Chapter 11, we are going to talk about a fundamental component of any solid financial plan: insurance. The topic might not sound exciting, but understanding its role is essential for protecting yourself and your assets from unexpected events that could otherwise have a devastating financial impact. As we begin this important discussion, we must state our mandatory disclaimer. The information provided in this chapter is for educational and informational purposes only. It is not intended to be, and should not be considered, financial, health, or legal advice. I am not a licensed insurance agent or financial professional. The world of insurance is complex and regulated. You should always consult with a licensed and qualified insurance professional to assess your individual needs, and to receive advice on specific products and policies. At its core, insurance is a tool for managing risk. You pay a regular fee called a premium to an insurance company. In exchange, the company agrees to provide you with a financial payout to cover specified losses or events. Essentially, you are transferring the risk of a large, potentially catastrophic financial loss to the insurance company in exchange for the certainty of a smaller, predictable payment. It is a safety net for your financial life. Let's discuss some of the most common types of insurance you will likely encounter as a student or recent graduate. First, and arguably most important in the United States, is health insurance. The cost of medical care in the U.S. can be extraordinarily high. A single accident or a serious illness without health insurance coverage could lead to medical bills that could take years, or even decades, to pay off. Health insurance helps cover these costs, including doctor visits, hospital stays, prescription drugs, and preventive care. As a student, you may be covered under your parents' health insurance plan until you turn 26. It's crucial to confirm this coverage. If you are not covered, your university likely offers a student health plan. Once you graduate and get a job, your employer will typically offer one or more health insurance plans as part of your benefits package. Understanding the terms of your health insurance is vital. Key terms to know are the deductible, which is the amount you have to pay out of pocket for health services before your insurance starts to pay, and the copay, which is a fixed amount you pay for a particular service, like a doctor's visit. The second type of insurance that many young adults need is auto insurance. If you own and drive a car, you are required by law in nearly every state to have at least a minimum level of auto insurance. This typically includes liability coverage, which pays for damages to another person's vehicle and their medical expenses if you cause an accident. You can also purchase additional coverage, such as collision coverage, which pays for damage to your own car from an accident, and comprehensive coverage, which covers non-accident related damage, like theft or a storm. The cost of your premium can be affected by many factors, including your age, driving record, the type of car you drive, and where you live. A third type of insurance that is highly relevant for students and recent graduates is renter's insurance. If you live in a dorm or rent an apartment, your landlord's insurance policy covers the building itself, but it does not cover your personal belongings. Renter's insurance is a very affordable type of policy that protects your possessions, like your laptop, furniture, and clothes, from events like theft, fire, or water damage. It also typically includes liability coverage, which can protect you financially if someone is injured in your apartment and you are found to be at fault. The peace of mind it offers for a relatively low monthly cost makes it a valuable consideration for any renter. When dealing with any type of insurance, the goal is to have enough coverage to protect you from a worst-case scenario, without being overinsured and paying for more than you need. Reading the policy documents carefully is essential. You need to understand what is covered, what is excluded, the limits of the coverage, and the amount of your deductible. A higher deductible will generally result in a lower monthly premium, but it means you would have to pay more out of pocket if you need to file a claim. In summary, Insurance is not an expense but a form of protection. It is a foundational part of a secure financial plan that shields you from the financial fallout of unexpected life events. As you transition from student life, your key priorities will be to ensure you have adequate health insurance, legally required auto insurance if you own a car, and to strongly consider renter's insurance to protect your personal property. Thank you for listening. In our next chapter, we will introduce the basics of taxes, a topic that will become increasingly important as you begin your professional career. Hello and welcome back. In our last chapter, we discussed the protective role of insurance. Today, in Chapter 12, we're going to tackle another essential topic for every working adult in the United States: taxes. The subject of taxes can seem intimidating, but understanding the basics is a crucial part of being a responsible citizen and managing your personal finances effectively. Our goal today is to demystify the core concepts of the U.S. tax system. Before we begin, we must present our most important disclaimer for this chapter. The information provided here is for general educational and informational purposes only. It is not, and must not be considered, tax or legal advice. I am not a certified public accountant (CPA), tax attorney, or licensed tax professional. The United States tax code is incredibly complex and changes over time. You must consult with a qualified tax professional or use reputable tax software for advice and assistance with your specific tax situation. The Internal Revenue Service, or IRS, at irs.gov is the official source for federal tax information. So, what are taxes? At the most basic level, taxes are mandatory contributions levied by a government, whether it's federal, state, or local, on an individual's or company's income. This money is used to fund public services that benefit society as a whole. This includes things like maintaining roads and infrastructure, funding public education, national defense, and social programs like Social Security and Medicare. As a student or recent graduate, the primary type of tax you will encounter is income tax. When you earn money from a job, you are generally required to pay a portion of that income in taxes. In Chapter 7, we talked about seeing deductions on your paycheck. This is the pay-as-you-go system at work. Your employer withholds an estimated amount of tax from each paycheck and sends it to the government on your behalf. This is a crucial concept to understand. You are paying taxes throughout the year, not just on a single day. After the year ends, you must file a tax return. A tax return is a set of forms that you file with the IRS, and in most cases, with your state's tax agency. The purpose of the tax return is to report your total income for the year and calculate the exact amount of tax you were supposed to pay. You then compare this amount to the total that was withheld from your paychecks. If your employer withheld more than you actually owe, you will receive a tax refund. If they withheld less than you owe, you will have to pay the remaining balance. To complete your tax return, you will need documentation of the income you earned. By the end of January each year, your employer is required to send you a Form W-2. This form summarizes your total earnings for the previous year and shows exactly how much money was withheld for federal, state, and other taxes. It is a critical document for filing your tax return. It's also important to know that not all income is from a traditional job. You might do freelance work or have a gig economy job. In these cases, you are considered an independent contractor. Instead of a W-2, the company that paid you may send you a Form 1099 NEC. The key difference is that when you are an independent contractor, taxes are generally not withheld from your pay. This means you are responsible for calculating and paying those taxes yourself, which often involves making estimated tax payments throughout the year. When you prepare your tax return, you'll encounter terms like deductions and credits. While we cannot give advice on which ones you can take, we can explain what they are. A tax deduction is an amount of money that you can subtract from your total income to lower the amount of income that is actually subject to tax. A tax credit is even more valuable. A tax credit is a dollar-for-dollar reduction of the actual tax you owe. There are specific deductions and credits related to education, which are worth learning about from official IRS resources. The deadline for filing federal income tax returns is typically April 15th of each year. Though this date can sometimes shift, it is very important to file your return on time, even if you owe money and can't pay the full amount immediately. In summary, the U.S. has a pay-as-you-go income tax system. Your employer withholds an estimated amount from each paycheck.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
After the year is over, you file a tax return to reconcile the amount you paid with the amount you actually owed. Key documents include the W-2 from an employer and the 1099 for contract work. Understanding the basic vocabulary and your responsibility to file is the first step in successfully navigating this aspect of your financial life. Thank you for listening. In our next chapter, we will discuss the basics of planning for retirement, even when it feels a lifetime away. Hello and welcome back. In our last chapter, we demystified the basics of the U.S. tax system. Today, in Chapter 13, we are going to take a giant leap into the future and talk about a topic that might feel incredibly distant, but is one of the most powerful financial moves you can make as a young adult: saving for retirement. It may seem strange to think about this now, but the choices you make in your early career can have an astounding impact on your financial freedom decades from now. Before we dive into this forward-looking topic, we must begin with our critical disclaimer. This chapter is for general informational and educational purposes only. It does not constitute investment, financial, tax, or legal advice. I am not a licensed financial advisor or investment professional. All investing involves risk. The information provided is meant to explain concepts, not to recommend any specific action, product, or strategy. It is essential to conduct your own research and consult with a qualified financial professional to determine the best course of action for your personal situation. Why should you, as a student or recent graduate, even think about retirement? The answer lies in the concept we introduced in Chapter 9: compound growth. Time is your single greatest asset. Because of the power of compounding, a small amount of money you set aside in your 20s has the potential to grow into a much larger sum than a much larger amount you set aside in your 40s or 50s. Starting early means your money has decades to work for you. When we talk about saving for retirement, we are generally referring to putting money into special accounts that are designed to encourage long-term savings. In the United States, these accounts have tax advantages. This is the government's way of incentivizing you to save for your own future. Let's introduce a few of the most common types of accounts in a very general way. First, let's talk about the 401k. If you get a full-time job with a company, they will likely offer a 401k plan. This is an employer-sponsored retirement savings plan. You contribute a portion of your pre-tax paycheck directly into the 401k account. This lowers your taxable income for the year, which is a nice benefit. The money in the account is then invested and has the potential to grow over time, tax-deferred, meaning you don't pay taxes on the growth each year. You typically pay income taxes on the money when you withdraw it in retirement. One of the most valuable features of a 401k is the potential for an employer match. This is when your employer contributes money to your account to match your own contributions, up to a certain percentage. For example, a common match is 50% of the first 6% you contribute. This means if you contribute 6% of your salary, your employer will contribute an additional 3%. An employer match is essentially part of your compensation package. It is often described as getting a 100% return on your investment instantly. For this reason, it is widely suggested by financial educators that you should try to contribute at least enough to get the full employer match, if one is offered. If you don't have a 401k through your job, or if you want to save more, another very common type of account is an individual retirement arrangement, or IRA. As the name implies, this is an account you open on your own, separate from any employer. There are two main types of IRAs: the traditional IRA and the Roth IRA. With a traditional IRA, your contributions may be tax deductible, which could lower your taxable income in the present. The money grows tax deferred, and you pay taxes on the withdrawals in retirement, similar to a 401k. With a Roth IRA, your contributions are made with after-tax dollars. This means you don't get a tax deduction now. However, the major benefit is that your money grows completely tax-free, and your qualified withdrawals in retirement are also tax-free. For many young people who might be in a lower tax bracket now than they will be in the future, the Roth IRA can be an attractive concept to explore. It's important to understand that these accounts, a 401k or an IRA, are just the containers for your savings. Within the account, you have to choose how the money is invested from a list of options. This is where the risk component comes in, and it's why consulting with a professional and doing your own education is so critical. The main takeaway for you as a student or new graduate is not to become an investment expert overnight. The key is to simply get started. Overcome the inertia. Start by contributing a small, manageable percentage of your income to a retirement account as soon as you are able. You can and should increase your contribution percentage over time as your salary grows. The habit of consistent, automatic saving is what builds wealth over the long term. In summary, saving for retirement early is one of the most impactful financial decisions you can make. Your advantage is time, which allows you to maximize the power of compound growth. Understand the basic concepts of employer-sponsored plans like 401(k)s and individual accounts like IRAs. And most importantly, appreciate the value of an employer match if it is offered to you. Thank you for listening. In our next chapter, we will discuss the importance of setting and working toward your medium-term financial goals. Hello and welcome back to our series on essential finance for students and recent graduates. In our last chapter, we looked far into the future at retirement. Today, in Chapter 14, we'll focus on the crucial time horizon that bridges the gap between your immediate needs and your long-term retirement. Your medium-term financial goals. These are the major life objectives you want to achieve in the next 3 to 10 years. And planning for them is a key step toward building the life you envision for yourself. As we begin, we must state our essential disclaimer. The information provided in this chapter is for general informational and educational purposes only. It is not and should not be taken as financial, investment, or legal advice. I am not a licensed financial professional. The strategies for pursuing financial goals are unique to each individual. You should consult with a qualified financial professional to develop a plan that is appropriate for your personal circumstances. What exactly is a medium-term goal? While short-term goals are about managing your money month to month and building an emergency fund, and long-term goals are about retirement, medium-term goals are the significant milestones in between. For a young adult, these often include objectives such as saving for a down payment on a car, putting aside money for a down payment on a first home, saving for further education like graduate school, planning for a major life event, such as a wedding, or perhaps saving to start your own business. These goals are exciting, but they require a different approach than just putting money in a standard savings account. They are too far away to be treated like a short-term goal, but too close to be treated like a long-term retirement investment. Achieving them requires a conscious plan and consistent action. The first step is to clearly define and prioritize your goals. It's easy to say you want to buy a house, but a more effective approach is to use the SMART goal framework we introduced in Chapter 1. Let's break it down again in this context. Specific. Instead of "I want to save for a car," be specific. I want to save for a $5,000 down payment on a reliable used car. Measurable. The goal has a clear target, $5,000. This allows you to track your progress. Achievable. Is this goal realistic given your income and expenses? If not, you may need to adjust the timeline or the amount. Relevant. Does this goal align with your values and overall life plan? Time-bound. Set a deadline. For example, I will save the $5,000 in the next 24 months. This process transforms a vague wish into an actionable plan. A goal of saving $5,000 in 24 months breaks down to saving approximately $208 per month. Now you have a concrete target to build into your monthly budget. Once you have a specific, time-bound goal, the next question is where to put the money. For medium-term goals, you face a balancing act. You want the money to be safe and accessible when your deadline arrives, but you also want to earn a better return than the very low interest rates typically offered by a standard savings account. This is a topic where doing your own research and speaking with a qualified financial professional is particularly important. One concept you might explore in your research is opening dedicated savings accounts for each of your major goals. For example, you could have a car fund savings account and a house down payment savings account. This helps you mentally separate the money and makes it easier to track your progress towards each specific objective. It can also reduce the temptation to dip into your goal-specific funds for everyday expenses. Automating your savings is just as critical for medium-term goals as it is for your emergency fund or retirement. Set up automatic, recurring transfers from your checking account to your dedicated savings accounts each payday. By making your savings automatic, you treat it as a fixed expense, just like rent. This consistency is the engine that will drive you toward your goals. As your income grows, it can be tempting to increase your spending proportionally, a phenomenon known as lifestyle inflation. A powerful strategy is to commit to dedicating a portion of every future raise or bonus directly to your medium-term goals. For example, if you get a 3% raise, you could decide to allocate half of that new income to your savings before you get used to spending it. This allows you to enjoy some of your increased earnings while significantly accelerating your progress toward your goals. Finally, review your progress regularly. Check in with your medium-term goals at least every 6 months. Are you on track? Do your goals still align with your life's direction? Life changes, and your financial plan should be flexible enough to change with it. A goal you set at 22 might be different from what you prioritize at 25. And that's perfectly okay. The plan is a tool to serve you, not the other way around. In summary, planning for your medium-term goals is about giving your financial life a clear direction. Define what you want to achieve in the next 3 to 10 years, and make those goals SMART. Create a dedicated savings plan, automate your contributions, and commit to saving a portion of your future income growth. By taking these deliberate steps, you can turn your future aspirations into achievable realities. Thank you for listening. In our final chapter, we will discuss the importance of continuous learning and developing a lifelong mindset of financial wellness. Hello, and welcome back for the final chapter of our series on essential finance tips for students and recent graduates. Over the last 14 chapters, we have covered a vast amount of ground, from budgeting and banking to credit, student loans, and planning for the future. In this concluding chapter, we will bring everything together and discuss the most important element of all: committing to a lifelong journey of financial wellness. As we conclude, it is fitting to state our disclaimer one last time. The information provided throughout this entire series has been for educational and informational purposes only. It is not, and was never intended to be, financial, investment, tax, legal, or health advice. I am not a licensed financial professional. The principles we have discussed are meant to serve as a foundation for your own research and learning. For advice specific to your unique situation, it is imperative that you consult with a qualified and licensed professional. Think of the topics we've covered as the creation of your personal financial toolkit. Your budget is the blueprint, the roadmap that guides your decisions. Your bank accounts are the storage, the secure place you keep your tools. Your understanding of credit is your reputation, which determines your access to other opportunities. Your knowledge of saving and investing is your engine for growth, building your future. And your understanding of insurance, taxes, and retirement are your safety gear and long-range navigation system. But a toolkit is only effective if the person using it has the right mindset. Financial wellness is not about achieving a certain net worth or never making a mistake. It is a continuous, evolving process. It is about building habits, being intentional with your choices, and extending grace to yourself when you stumble. The most important habit you can cultivate is the habit of awareness. This means regularly checking in with your finances. It means having a monthly budget meeting with yourself. It means knowing where your money is going and being honest about whether that spending aligns with your values and goals. This awareness is your compass. Another key component of a healthy financial mindset is to avoid the comparison trap. In a world of social media, it is easy to see the curated highlights of other people's lives and feel like you are falling behind. Remember that everyone's financial journey is unique. Your income, your goals, your challenges, and your opportunities are your own. Focus on your personal progress, celebrate your own victories, no matter how small, and stay on your own path. Financial education does not end with this series. The financial world is dynamic. Products change, laws change, and your life will certainly change. Commit to being a lifelong learner. You can do this by reading books from reputable personal finance authors, listening to podcasts from qualified experts, and following reliable news sources. Government websites like those from the Consumer Financial Protection Bureau, CFPB, or the Securities and Exchange Commission, SEC, are excellent, unbiased sources of information. As your financial life becomes more complex, perhaps you start a family, buy a home, or advance in your career, there may come a time when it makes sense to seek professional guidance. Knowing when to ask for help is a sign of strength, not weakness. A qualified, fee-only financial planner can provide a holistic view of your finances and help you navigate complex decisions. The key is to find a fiduciary, a professional who is legally and ethically bound to act in your best interest. Finally, remember that money is a tool. It is a means to an end, not the end itself. The purpose of building these healthy financial habits is not just to accumulate wealth, but to create a life with more freedom, less stress, and more opportunities to pursue what truly matters to you. It's about having the security to weather a storm, the freedom to change careers, and the ability to be generous with others. You have taken a significant step by investing your time to learn these foundational principles. You now have the knowledge to build a solid financial house. Start with the foundation, a positive mindset and a working budget. Then build upon it, one brick at a time, by managing your credit, saving for your goals, and protecting your future. Be patient, be consistent, and be proud of every step you take on your financial journey. The habits you build today are a gift to your future self. Thank you for listening. We wish you the very best in all of your future financial endeavors.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.